If you want to grow and scale your rentals beyond just 1 or 2 properties, investor mortgages are the key. So this episode is a conversation with a mortgage expert who shares how to keep financing rentals even when you hit a limit with your income or you run out of down payment. Let's get started. Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach Carson, and this is a show to help you get out of the financial grind so you can spend your time doing more of what matters. My conversation today is with Bryan Maddex. He's a mortgage professional I have known and respected for years, and he's also a real estate investor. And what I really like about Bryan is he knows about all of the different programs, all the different nuances. And what we're going to do today is go into the details of scaling a portfolio. How do we get there? What loan programs are best? So Bryan, you've probably heard me say this before, but one of my favorite analogies with financing is that we have to have this toolbox of financing tools. So almost like a carpenter's building a house, and they have to have, a saw and a hammer and a screwdriver and all this stuff. Well, in financing, it feels like to build like a financial house of rental properties is the same way. And I knew that you are like the master carpenter of investor mortgage lenders, and I would love to explore this. And the main idea I want to start with is that I'm a rental investor. I'm not brand new. I already own a few properties, and I want to grow more. Like I want to keep buying more. Maybe I want to own 10, maybe I want to own 20. But the point is, I feel like financing is an obstacle to me continuing to grow. Maybe the down payments are an obstacle. So my first question for you would be, I want to talk about like the vanilla type of loans, which for me is like a conventional loan. And can you talk to me about like what that whole like vanilla conventional loan program is from an investor standpoint? And then maybe I'll have some follow-up questions about, how to apply it.
That's a great question. And when you think about conventional financing, I kind of think of that as the gold standard, right? If you can do it, if you can survive it, because it is more work to do a conventional loan, it's going to get pretty intrusive with documents, especially once you start growing your portfolio. But the pain is worth the effort, typically, because you're going to get a loan with no prepayment penalties. Your interest rates are typically going to be the best that you can do. It's fully amortized for 30 years, so it's very predictable. You can keep that one loan forever. A lot of different loan types that we have to consider, we're going to see what's the downside, and we're going to compare it to that conventional loan, right? So if we can go conventional, is that going to be the best way in the gate? Typically, yes, unless you've got 7 or 8 properties and it's okay to pay a little higher rate for the less hassle of another option. But conventional financing, I always tell people, if you were able to buy your last house using a conventional loan, which is a Fannie or a Freddie loan, then you should be able to buy an investment property. If you've got the cash for down payment, you should qualify. One of the nice things about conventional financing is we can use future projected rental income to help you qualify on that purchase. So if you qualified for your last refinance or your last purchase, ideally you qualify for this one on an income approach because we're adding income from this new house to help you buy.
So that might be a first question that people have. If they're pretty new to it, they might be like, all right, I have my principal residence, my house. I bought one rental property. How in the world am I going to keep buying more property? Because they've heard of this thing called a debt to income. I want you to define here in a second. But they feel like, oh, wow, the more mortgage debt I get, the less likely I can get another loan because I'm just going to run out of, I'm just going to have too many mortgage payments. So can you unpack that a little bit more and say, so you said that you could use the future rent of a property in order to help you qualify for the next loan. What does that mean?
Yeah. So if you have a history of housing payments, right? You've owned a home for a year or you're on a lease agreement for a year, then you have a history of housing payment. And when you have that history of housing payment, we use the future projected rental income. The appraiser actually does a market rent analysis. It's called a 1007 schedule on an appraisal, but they go out and they look at what should this house rent for on a long-term rent basis, right? A 12-month standard lease. And let's say they come up with $2,000 as the projected monthly rental income. We take 75% of that and add it to your income as you're buying this house. So we're going to add $1,500 a month to your income because you're buying this investment property. We know it's going to be income producing. So that extra income is going to help offset the new mortgage payment. And ideally, your rent is going to be in that similar ballpark, right? Of 75% of your mortgage payment. The smaller the house, the easier that is. The smaller the purchase price, the easier it is for that to work out. The larger the purchase price, the harder it is because a $100,000 house isn't going to earn half the rent of a $200,000 house, right? A $200,000 house isn't double. You might be 75% more or 50% more on the rent from a $100,000 house. So we do have to do some math and think about what's the projected rental income for the property you're purchasing. But if you qualified for your primary residence, you should qualify as long as you haven't added debt since your last purchase, right? A car loan or some big credit card balances. You should be able to get the debt to income to work on the new purchase.
Got it. So that's a good sign. Like, so, all right. So it's possible that you can keep buying more properties and using this kind of gold standard loan that we're talking about, conventional loans with income. Income doesn't necessarily have to be a disqualifier, but let's dig into like qualifying in general, because you mentioned that conventional is a gold standard, has 30-year fixed, usually the best interest rates. It's the best terms you can find, but it also is harder to qualify. So can you unpack a little bit more of like, what are the hurdles you have to get over to qualify for a conventional loan?
Yeah. So the first hurdle is going to be your credit score. Your credit score is going to factor in how high of a loan to value can you borrow against, right? So if you've got a 680 credit score, you may need to put 20 or 25% down to get that initial approval. If you've got a 740 or a 780, you can put down 15% and still qualify because the risk of the loan, your credit is overcoming that risk. So that's kind of the first hurdle for a lot of investors is credit score. Credit does matter greatly. Every 20 points makes a difference on your interest rate and on the likelihood of getting an approval for the loan to value that you're seeking. The second major obstacle is debt to income. So on debt to income, we're looking at literally your debts, how much your minimum payments are that report to credit. It's your car loans, your student loans, credit cards, your other mortgages to income. So how much money do you make? So let's take round numbers. Let's say you make 10 grand a month in income. 50% debt to income would be 5 grand a month in total payments. So we can have up to 50% debt to income on a conventional loan when we're looking at good credit scores, probably 720, 740 credit scores. When you're in the 680 to 720 range, you may only get approved with debt to income up to 45% of your income. So those are the kind of the first two harder obstacles with a conventional loan is the credit score is going to matter a little more on how much you can leverage of that house. And then your debt to income is going to matter greatly because we can't exceed 50% debt to income on a conventional loan. And these are full doc loans, Chad. So we need tax returns, bank statements, W-2s, pay stubs. We need all your documents when we do a conventional loan because we're getting you well qualified. It's called a full doc loan.
So basically you have to prove your case. Like I might tell you, hey, Bryan, I make $10,000 a month, but you're gonna be like, all right, the underwriter wants you to prove it. So you have to have, I guess, tax returns for a couple of years ago. You have to have bank statements, things like that can actually document that, yes, you really do make $10,000. And I imagine somebody who's self-employed, like I've always been self-employed, has a little bit harder time than somebody who has a W-2 income from a very, long-term job. Is that true? Is it a little bit harder for the self-employed person?
When we look at a W-2 employee, we look at your top line income, your gross income. And when we look at a self-employed borrower, we look at your bottom line income or your net income. So just from the get-go, we're looking at a different set of numbers if you're a W-2 employee versus if you're self-employed. Self-employed borrowers normally need a 2-year average of income. So if last year you didn't do quite as good as you did the year before, your income's declining. We're going to take the worst of those 2 years. If your income, if you doubled it in 23 versus 22, we're only going to get you halfway to that extra income that you earned because we're taking that 2-year average. Sometimes we can use 1-year tax return depending on how long you've been in business. But if you own extra rental properties and we want to use that rental income, we're back to needing 2 years tax returns. So for most investors, if you have one property under your belt and we need to use that income to help you qualify for this loan, even if the guidelines say, hey, for you, Chad, because you've been doing this so long, we only need 1-year tax returns to count that rental property. We now need to see 2 years tax returns again. So sometimes we want to only use 1 year because we had a banner year last year, or our income was declining a lot, but it's still good. It's just if it declines too much, the bank is going to say, hey, we don't like this trend. We want you to have another year to see if you're going out of business or if this was an anomaly and you're going to recover next year. So it can be challenging on the conventional side, but that's why it's the gold standard and that's why it gets the best terms because it's the most documented and it's the safest for a lender.
So I just want to give a little, tease towards later in the episode. We're going to talk about a whole set of loans that if you are self-employed, if you're somebody who retired and now doesn't make regular income, there's other options and there's a different path there. But I guess I want to say what I'm hearing is if you're somebody who has a steady job that has easy to document income from like a W-2 tax form, you make well over your debt to income ratio. So you're making $500,000 a year and your debts are pretty low. You're like the gold standard borrower for a conventional loan, right? Like you have good credit, good income, plenty of space there. So for you to go out and buy 5 rentals or 10 rentals as a high earner with a W-2 job is a much easier task than me. Maybe I was flipping houses and I was wholesaling houses, but had a lot of deductions and it was up and down every year. So like, I'm going to be a tough conventional borrower, where a doctor who makes $500,000 a year, who wants to buy some rentals on the side, a little bit easier. Is that kind of an accurate statement there?
That's very accurate. And we've got a loan for everybody. Like you said, we'll talk about some of the alternate document loans that we can go into. But when we're looking at that gold standard, it's the hardest to qualify for on both the credit side and the income side. But if you can qualify, there are some perks to that. I do a lot of loans for people that don't have W-2 jobs. I do a lot of loans for people who don't have any job. They're just real estate investors. They only have passive income from rental properties. And I've done loans for people who have gotten declined from banks when the bank said, hey, we know you own 10 properties, but you're not showing enough income. Well, a lot of times those banks aren't giving add backs for depreciation or certain things that the mortgage industry can give you credit for. So just because a bank told you no doesn't mean you're not able to borrow. It means you need to talk to a mortgage person who understands investors specifically, because there's a lot of times where we say yes when a bank has said no on a mortgage.
I love it. Yeah, you're the guy with the toolbox. That's what I was saying earlier. I love that, because most of us think we have a hammer. That's what we want to use. Conventional loans is the hammer, but there's a lot of other tools. So I want to start talking about building that structure. All right, we want to build this rental property portfolio. We've already got a couple conventional loans. I want to fast forward and say, all right, I want to now buy 3 more rentals over the next 2 or 3 years, right? So I'm going to start growing. At what point might I get cut off with conventional loans? What are some of the ways that I might bump up against the ceiling of like, I can't get any more of these?
That's a great question. So when we look at the limitations of conventional loans, the 3 most common things I see for investors is, number 1, they run out of cash. They don't have the down payment money any longer. Number 2, they run out of accessibility. Fannie Mae only lets you have 10 properties that are mortgaged. If you're buying an investment property, you can always buy a primary residence. So you can have your 11th or 12th mortgage if it's a primary home. But if it's investment home, Fannie Freddie cut you off at that 10. And then number 3, the debt to income can be a factor. Once you've got your last property rented, it's now offsetting that mortgage payment. So hopefully you can keep going as long as you're doing long-term rents. What I see a lot of investors do is they'll buy a second home or a short-term rental, and we can't count the income from that short-term rental until it's hit tax returns, right? So Chad, if you said, hey, I'm going to go buy 3 short-term rentals, I can't count the first 2 short-term rental incomes that you bought this year on your debt to income, because you haven't filed taxes this year to show me what those are producing in income. It doesn't have a long-term lease. So we can't take 75% of your lease income to offset that mortgage payment. So that's when you're trying to grow some of your alternative investment styles, right? So you're outside of the long-term loan, that can be an inhibiting factor for being able to get conventional financing until some of those incomes start to report on taxes. And now we can use that income to offset that debt.
Yeah, that's a good example. I feel like a lot of when I'm coaching people in rental property mastery, for example, a lot of the ceilings that people are hitting are income source ceilings with their financing. Like, all right, it's a short-term rental that hasn't seasoned yet. Like you're talking about, it's not on your tax return. Or, hey, I'm out flipping houses, but I only did it for 1 year. Therefore, I can't like show that money. So even though like it's kind of frustrating for investors, like I have money in the bank, like this money is coming in right now, and yet I can't count that necessarily because it's not like I can't prove it on a tax return. So that's a common ceiling. I'm glad you also mentioned the down payments. I want to go back to that here in a little bit. People just run out of cash for down payments. So we'll talk about some creative strategies there to do it. But I want to move from this conventional world and really compare this to a different product, which you do a lot of as well, called a DSCR loan. So that's a mouthful, DSCR. So maybe let's just start with like, what does that even stand for? And then let's kind of compare and contrast conventional with DSCR.
Yeah, great. So DSCR is debt service coverage ratio. So debt service, you're servicing your debt. That's your payment. And then your coverage ratio, coverage is your income. And then the ratio is how much more income do you have than your debt? So we literally are looking at the property itself. What's the income that this property is going to produce versus the payment that this property is going to have? We don't look at any of your other debts. We don't look at your tax returns. We don't look at your W-2s, pay stubs. You don't have to be employed. You don't have to declare any income at all. We're just looking at that subject property. If the property is going to produce $2,000 a month in rent and your payment is $1,950, you have exceeded a ratio of 1.0. So you have more income than you do payment. And so the goal on most DSCR loans for single and 1 to 4 family properties is that your payment's $1 less than your rent, right? So we want your rent to exceed the payment. Now, there are products that can go lower than that at a cost. So there's a lot of different ways that we can do DSCR loans. They have what they call a DSCR 75. So that means your rent covers 75% of your payment. So you're not at that 1.0. It's going to be a higher rate. You may need to put more down, or you can do a no ratio loan where they don't even look at the income. So those are going to be higher interest rates or bigger down payments. But the DSCR space has 1,000 options within it and 1,000 different ways to calculate the income. Sometimes we're using a 1007 or that market rent analysis from an appraiser. Sometimes we're using an Air DNA report. That's going to be for short-term rentals. So we can use a percentage of the Air DNA based on kind of estimated occupancies for that area to generate an income. So when we talk about DSCR, there's not a one size fits all. There's a lot of options inside that term DSCR.
That's a good start. I want to dig into some of those details you just talked about, but I want to go back and highlight what I think some of the biggest similarities and differences are between a DSCR loan and a conventional loan. And by the way, when I first started, I've known you for a long time, Bryan. I wish we had DSCR when I was growing my portfolio because it's such a interesting tool and helpful tool. It would have been for me big time. But what I heard you say is on a similar note that you have to put money down. I don't know if we talked about that. You still have to put cash down. How much? What's a typical down payment on a DSCR loan?
15 to 20% is very normal in the DSCR space. On all loans, conventional or DSCR, the less you put down, the higher the risk, the higher the rate. So, and then you're higher your payment as well. So cash flow is going to be tougher if you do 15% down versus 20%.
So there's some nuance there, but in general, hey, you still got to put money down or you got to have equity in a property in order to get a DSCR or a conventional loan. The other thing I love about DSCR is like conventional loans, there's 30-year fixed mortgages, which in the past, if you were to fully amortize a 30-year fully amortized loan. So those two things are similar, which I think is a huge positive of DSCR. But then the other positive is that what we're talking about here with the income is like that ceiling we were all hitting at the conventional loan where we either didn't have enough income or our income sources from short-term rentals or something else. What you're telling me is they don't even look at your job income. They just look at the property's income. And so if you have a good property that produces enough income, at least a 1 ratio was what you're saying, then that could technically qualify. If you have the down payment, you got the credit. We didn't mention that. You have the credit score, then you can qualify to get a DSCR. They're not cutting you off at 5 or 10 loans. You can keep going beyond that 10. Did I summarize that? Okay.
Yeah. And so we did mention Fannie Mae allows you to have up to 10. DSCR lenders may have limits. They may say, hey, we only want to finance 4 or 5 or 10 for you. Some might say, hey, we want you to cap out at 20 total finance properties. Many lenders have no limits. And the nice thing is there's so many different lenders out there that you can always go get more DSCR loans, right? There's literally no cap to how many DSCR loans you can go get except for your cash out of pocket. The other nice thing about the DSCR is we're leaving the job blank. When you do the application, you're not even telling me that you have a job or that you're employed or self-employed. That's completely blank. So the benefits of the DSCR are going to be, it's very specific to the property to qualify income-wise. The assets are going to be very similar. DSCR has more flexibility than conventional when it comes to down payment. If you wanted to buy a 2 to 4 unit property using a conventional loan, you've got to put 25% down. But in the DSCR space, you can do 20% down. Cash out refinances. On the conventional loan, you're capped at 75% loan to value, where DSCR, you can go up to 80% on a cash out refinance. So there are some advantages going DSCR where sometimes someone does qualify for conventional financing, but their situation or their objective and goals for this transaction leads us away from the conventional financing and going into a DSCR loan for that increased flexibility.
I like that, which again comes down to like having the toolbox open and having somebody who knows what they're doing with the toolbox. Like I always talk a lot about team, Bryan, you know this, is like if you're an expert at one thing, you got to bring like an all-star team of people who know what you're doing. So like this is why, you have a mortgage lender. If there's hundreds and hundreds of DSCR programs and everyone has a little bit of nuance, like I've been investing for 21 years and I have no idea how all of those programs work. You got to consult, somebody who knows what they're doing. So I'm just going to make sure that's a plug that people realize that like, this is a really important team member, because it could be the difference between you being able to do a deal and not being able to do a deal. You might think you're up against a wall and you're like, oh, can't do it anymore. And then you talk to Bryan and he's like, well, actually, there's this other program that can be 15% down because you have a good credit score. I mean, that's something I didn't even know about. Like that's pretty incredible.
It's funny because I'll talk to people and be like, oh, I can't get financing for this property. I wish I could. And I'm like, who said that? Right. A lot of times it's a bank that's very conservative and only has their bank products. When you do financing at a bank, they don't even let you go up to 10 investment properties. They normally cap you at 4 investment properties. So I worked in retail banking for 17 years. As soon as I joined the mortgage industry, I decided to go network inside of real estate investor associations because I know that banks just blanket statement don't like investors, right? They don't have the capacity to service investors. They don't have the creativity to read tax returns and to give you the add backs that Fannie and Freddie allow. So the banks oftentimes are going to be so conservative that I talked to many people who they got declined after they were under contract, and we had no problem getting them closed. We just had to go a different approach. And so just because a bank says no, it doesn't mean you're not lendable. It means you're working with the wrong lender.
I think it also helps that you have rental properties yourself. So you're like, all right, I kind of get what you're talking about here. And I know what you're trying to go through.
Well, and I'm always looking for the angles for me in my investing, Chad. Like I read a lot of guidelines, and I know that the number one reason most investors stop buying is they run out of cash. And so I try to find the edges inside guidelines on how can I preserve my capital, because that's a major part of my ability to continue to grow. It's having the capital. So being an investor, I'm looking selfishly, but my clients benefit because I can help find the edges of the guidelines where we can ethically and legally cheat, right? So sometimes we buy houses as a second home. And if your income is disposable, you don't need income from the property. A second home lets you put 10% down versus 15%. So my wife and I, we bought 5 second homes, right? So we didn't need the income from the property as we purchased them. And it let me buy more homes because we had purchased them as second homes. You need to have disposable income. You can't count those properties as income producing, but you can do 10% down on a second home versus 15 or 20% down. So it's looking at the scenarios and the situation, and there's no best loan. There's only a best loan for what you're trying to do.
Going back to the toolbox metaphor over and over again, that the second home tool was another tool I didn't even think about, but you can use that in certain cases. So before I overwhelm everybody, I want to go back to these two main tools we're talking about: conventional tool, and which is a gold standard in terms of terms, and then this DSCR, which we've started unpacking a little bit. And I think we've given a better understanding of like the benefits. Hey, these are all the pluses of DSCR: 30-year fixed. You don't have to use your personal income to qualify. I don't want to make everything like a rose-colored glasses. Like there's always a plus and a minus. So what are some of the challenges maybe from the term standpoint, some of the negatives or these things that an investor needs to be aware of with a DSCR compared to the conventional loan?
Yeah, that's a great thing to really understand what a borrower is trying to do or what a buyer is trying to accomplish, because DSCR loans, one of the biggest downsides of them is to get the best rates, you're going to have a prepayment penalty. The best rates on a DSCR loan come with a 5-year prepayment penalty, which is normally a declining penalty. So it'll be a 5% fee if you pay off the loan in the first year, a 4% fee in the second year, 3 the third, 2, 1. You can shorten the prepayment penalty to 3 years, 1 year, 0 years, but everything comes at a cost. So if you're trying to do an 80% cash out refinance with a 0 prepayment penalty, those rates today might be in the 9s. Now, depending on when you watch this video, that might be a really good rate or a really bad rate. But if you have access to the capital and you can deploy that capital, sometimes it's okay to have a rate in the 9s. But we just have to analyze the cost of funds versus what you could put those funds to work and go on to do. The other hard part with a DSCR loan is there's no standard. You know, Fannie Mae and Freddie Mac, they have standard guidelines, and banks can do overlays on top of those guidelines. But if you talk to any mortgage lender, the base core guideline is the exact same if you're going a Fannie Mae loan. In the DSCR space, there's 200 different companies that do DSCR loans, which means there's 200 different ways to analyze a loan with DSCR. If it's short-term or long-term, if it's seasoned or not seasoned, if you're doing 75% financing or 80%, if the property's occupied or not occupied, if you did rehab or didn't do rehab to it, if you have experience or don't, do you own a primary residence? Do you not own a primary residence? Have you had other investment properties? So I have to ask a lot more questions when we're talking about a DSCR loan, because there's 1,000 ways to do a DSCR loan and there's 200 lenders that do them. So it's really kind of threading the needle sometimes for a manufactured home that's rural and you're doing a cash out refinance, right? Most lenders are like, no, we're not going to do that. But I've got 3 lenders that'll do cash out refinances on rural DSCR properties, right? For manufactured homes. So there's a product for that, but the rates aren't going to be nearly as pretty. So really understanding the situation and picking the right lender is paramount when it comes to DSCR. There's just no standard guidelines.
You and I were kind of joking before the call that like behind the scenes, you as a mortgage lender, you must have like this huge chart of like all these lenders and like what they will do, what they won't do. So for me as a borrower, like I need to understand, all right, DSCR is a umbrella of loans that basically look at the income of the property. But then within that sphere, or that universe of DSCR, I want to give you a couple of examples. Like maybe there's one lender who says you have to have 6 months of cash reserves, and another lender that maybe says 3 months or no months. Like, is that the kind of thing that's different from lender to lender?
Yeah. So I've got one lender that wants 9 months reserves on the subject property plus 1% reserves of all mortgages that report to your credit report. So if you've done your 10 conventional loans, 1% of 10 conventional loans could be a tremendous amount of reserves. And some lenders, if you're doing a cash out refinance, they'll use the cash out as reserves. Other lenders say, no, that doesn't count as reserves. So there's so many different scenarios, and I have a massive spreadsheet, and I'm always adding data to that so that I can try to make my search a little shorter. But working with a broker, you don't have to start over if I say no. When I worked at a mortgage shop where I only sold a certain number of products, I either said yes, no very quickly because I had a very tiny box of what I could finance. And now that box is blown up. And so sometimes it's just a little bit more effort to go find the right lender for your unique situation.
Yeah, so it's harder for you on the back end with your big spreadsheet. But for me as a borrower, and I guess that's the point I want to make in this episode, in this video, is that we've never had more options in terms of financing. That's this thing that really excites me about, not only conventional, but then getting into the DSCR space. And there's several other loans that we haven't talked about that are just different kind of nuances of kind of unconventional types of investor loans. So I think the message I want to express is like, if you want to scale, if you want to grow, it's possible, but you're going to be in for a little bit of a roller coaster ride, and you need a conductor to kind of like get you through that. And so I want to transition. I think this will help kind of sink in some of the pluses and minuses, the differences between a DSCR and a conventional. I just want to give you some situations because I know this is something you do all day. Is you have calls with people, kind of consultation, and then they tell you their story, and then you kind of it's like a matchmaker. Like you're trying to match this up. So let me give you just some basic scenarios, and then you tell me what you're thinking as I tell you that. Is that okay?
Sure.
So I want to give you a very typical scenario for somebody who is, they already have 2 or 3 rental properties. They're now trying to buy the next property, and they decide to do the BRRRR strategy, which if people haven't heard of that, they're going to buy a fixer-upper property, and they're going to, instead of flipping the house and buying it at a low price and just reselling it, they're going to buy it at like, 60 cents on the dollar. Let's give some real numbers. They're going to buy it for $120,000, but the property is ultimately worth $200,000, but they're going to put, let's say, $30,000 into it. So they have $150,000 invested in this $200,000 property, and then they turn around and rent it, for $1,600 or so. So they just went and they just paid cash for it. They have a home equity line of credit. They just paid cash for it. Now they come to you. They say, "Hey, Bryan, I've heard you do these long-term investor mortgages. I have this $150,000 invested in this $200,000 property. It's rented for $1,600. What now?" What kind of loan does that point you towards, just from what I've told you so far?
So the first question I've got to ask is, how long have you owned the property? Did you buy it last month and rehab it, or did you buy it 7 months ago and rehab it? Because that's going to change the access to funding. So if you've owned it longer than 6 months, Fannie and Freddie will allow you to do 75% cash out refinance. If you have owned it less than 6 months, we may have to go to a DSCR loan that has no seasoning requirements. So that's where we get into that massive spreadsheet and finding the lending partner that's going to come fit within your specific situation. The third question I'm going to ask you is it occupied now or not occupied? And is it a short-term rental or is it a long-term rental? Because those are going to further narrow down what programs are going to fit for your situation on this refinance.
Got it. All right. So I'll answer a couple of those just to give us some real nuance there. Is that I just got it rented 2 months ago. So I bought it in a month and fixed it up. I've only owned it 3 months. I've had it rented for a couple months, and they've all been short-term and mid-term rentals, not a long-term rental. So where does that point me now?
So now we have to go DSCR because you've not owned it for 6 months. So Fannie and Freddie would only use your purchase price. So if you wanted limited funds, I could give you some, but if you bought the house for $100,000 and you put $50,000 work into it, I'm only able to give you a $75,000 mortgage on a Fannie Freddie called a delayed purchase. That's when you bought the house cash, but we use your original purchase price as the value for the first 6 months. So since you want to go up to $150,000 and get all your money back, we're going to go with a DSCR lender that's okay with it being short or long-term rented. We've got a bunch of lenders who just want to see the house is occupied. Occupied means stuff is in the house. So if it's a short or midterm rental, it is occupied. They're going to usually use a 1007 market rent analysis to verify what that $1,600 a month income is. And as long as our payment is $1,599 or less, we're a go. We're a go to get you that $150,000 back.
So that $1,599, is that, again, the debt to income ratio? So if my payment is $1,599 and I have $1,600 in rent that I can show, that gets me over that 1-to-1 coverage that the DSCR lender would be looking for.
Yep. And so we're going to hope that works.
So I'll throw one more nuance that you mentioned something interesting, is that I paid cash for that property. I used a home equity line of credit on my residence. And so I have no mortgage on that property. But if I did have a mortgage, let's say I had borrowed hard money or a private money, hard money loan, let's use that example. So it's a third party lender who loaned me, $150,000 $50,000 to fix that property up. Would that change anything in that scenario?
That would. That now allows us to do a Fannie Freddie refinance if you qualify for Fannie Freddie, because we do not have seasoning requirements on a rate and term refinance. So if you were strategically able to get your acquisition loan and your rehab cost all in one loan, so you got your hard money loan for 150 grand, now I can refinance that as soon as you finish the rehab. It could have taken you 2 weeks or 4 months, but I'm able to do that refinance as soon as the house is in go position, right? As soon as your rehab is completed. And it doesn't have to be occupied if we go Fannie Freddie, because we can still use that market rent analysis to project the income to add to your income. So that would greatly change that scenario if we were paying off. So being strategic on your hard money loan at acquisition time is really important for access to funding when you're completing your renovation project.
Yeah, there's so much to think about there, right? I just love that one example. We went from long-term rental to short-term rental. We talked about having a loan on the front end versus not having a loan, to seasoning requirements, not seasoning. So this puzzle has a bunch of pieces there just between choosing a conventional and a DSCR type loan. But the positive of that is that if you can put those puzzle pieces on the table like you do, that there's often an option. Like that to me is very hopeful, because I've run into scenarios, my own business in the past, where you're like, I don't have many financing options here. Whereas what I'm hearing is, there's a lot of variability, but that also means you got to go back to your spreadsheet and say, all right, which one of these lenders fits?
Yeah. And a lot of times I get that scenario, just like you said, hey, I bought the house cash and I want to take my cash out, but I don't want a prepayment penalty. Well, that's going to be expensive, right? Because now we've got to go with the DSCR, no seasoning, no prepayment penalty, and we're going to pay a healthy rate for that situation. So if I can get involved with you, Chad, while you're buying your property, I do have about 20 hard money lenders. I'll help you be strategic on how should you finance this at acquisition time, thinking of the end goal. Right? We want to think of the end results. What's our plans for the property in the future? And how can we back into the perfect scenario on the front end? So being a little bit more strategic when we're making our offers and when we're doing our initial financing can help us greatly on the back end as well.
So I think that's a good segue. So we've gotten in the weeds a little bit with the conventional loans, the DSCR. I know there's probably another 45 minutes to 2 hours of weeds we could go into. So everybody let us know in the comments if you're watching on YouTube or if you're listening on Spotify. Leave a comment. Let us know what kind of specific questions you have and we can follow up. And Bryan will be reading the comments as well, can help you out with that. But I want to transition to what you just said, the strategic thinking about financing, because really this episode has been all about growing your portfolio. You're starting with a few properties and you're wanting to get to more properties. You're wanting to get to 9, 10, 20 properties. I want to think about some of the main obstacles that we run into. And we've kind of hit one of those that is, hey, what if I hit my 10 loan limit with Fannie Mae? Or what if, I don't have enough income? And so we've solved those to an extent. But there's another big one that you and I both know often happens is just running out of cash. Like I don't have any more down payments, because everything we're talking about here, it either requires you to put 15%, 20%, 25%, or to do a BRRRR strategy. And it's not always every single deal that you buy a deal low enough that you can pull out 100% of your cash. I mean, that's a pretty difficult thing. You're pretty consistently have to put money into a deal. You got to have some skin in the game. So I just want to talk strategy with you. You worked with a lot of investors. For those who have been able to scale, what are some ways we can think about to conserve our cash, to recycle our cash, that to actually be able to have enough cash on our end to be able to come back to you and do more loans? Do you have any thoughts on that?
Yeah, there's a whole bunch of options to how do I get more cash. If I've got some properties, we could look at doing a second mortgage on investment properties up to 80% of the value of the home. That could be on a fixed second mortgage. That could be on a home equity line of credit. That could be a private note from a lender that you met at a networking group. Doing a home equity line of credit on your primary residence could be an option. Lines of credit are not meant for long-term financing. They're meant to help you get the product, the property under your belt, and then transition to long-term financing. You want to rinse and repeat and leave that line of credit open. So it needs to be strategically used so that you don't run out of that, because it's another asset base that you could run thin on. A lot of my clients who do have W-2 jobs, a 401k loan, a lot of times you can do up to 50% of the value of your 401k or up to $50,000, and your interest goes into your own 401k. DSCR, if you're doing a DSCR loan, some of those lenders will let you get gift funds. Some of those lenders will let you pull in a strategic partner where we don't verify the assets. So maybe you're going to do a private second note, but instead of having a private second note, because lenders won't allow that, you sell a portion of your LLC that's buying this property so that they're getting an equity position of that property. Chad, I'd rather have 75% of the income and appreciation of a property than 0%, right? So sometimes if we're out of cash, we find a capital partner that can help be strategic, or you put a private note on an existing property so that you can continue your acquisitions. So there's a lot of ways to go forward. None of them are right and none of them are best. It's just what access do you have available and how do we pick the best solution for your situation.
Yeah, I like it. It sounds like you're looking at the assets you have. So if you already have rental properties and you already have equity, then some of those other options, the second mortgage, the line of credit, even selling. I love the idea of selling equity to a partner. That's another option that you could use. I wanted to explore that one a little bit more because I've done some videos here on the channel where I talk about partnerships and I use the exact same analogy that we're on the same page, that I would rather own part of a deal than and have to give away half the deal or 3/4 of the deal or 25%, give away part of it. But now I'm getting to eat. Now I get to eat that pie that I wouldn't have had otherwise. Like that's it's a mentality that, so many people run into. They're trying to get 100% of everything. They're kind of thinking with that limited mindset, as opposed to saying there's millions of people out there who want to get in on real estate and they just want to find a person like you who's willing to find the deal, operate the deal, manage it. So what I'm hearing you say is, in the lending world, having two people come together and have a partner. So if I don't have the down payment, if I came to my friend Sean and Sean has a down payment, he has good credit, like could we do the deal together? Like, so could we in an LLC buy the deal and then he's the one who brings the down payment? Is that okay with lenders to do something like that?
In the DSCR space, it's wide open. There's solutions for every option and situation that's out there practically. So sometimes you might not have the credit, but you've got the income or the assets. Right. And then Chad, you might have no assets, but you've got the credit. Well, I need your credit and you need my assets. So we come together and we do a partnership or a joint venture and be strategic on how do we go get some more houses. You can have a 20% owner of an LLC be the primary borrower, right? Some DSCR lenders, they'll take the higher of your two credit scores. Some will take just one owner that's got a 20% or 25% equity stake. So finding those strategic partnerships, and it could be a credit partner or it could be an asset partner. But if you've got part of the puzzle, maybe you don't have either, but you're really good at finding properties, right? So maybe there are some other people that, man, I don't have the time to find the properties, but I've got the income, I've got the credit, I've got the assets. So yeah, there's all kinds of ways to make money in real estate. Nothing is best and nothing is right. It's just finding a way to make it work.
I find that when I was a new investor, just getting that idea in my head, that it opened up an entire world of possibility. Like the idea of scaling my rental portfolio, once I knew that there were other people out there who could put up the money, or once I learned that there was somebody like you, Bryan, that has 200 financing options instead of just like the one or two that I thought I had, all of a sudden now I'm like, okay, I got options, I got possibilities. And what that did for me was that I could then go confidently make offers, because if you don't have the financing in play, like it's almost like you're going out. I don't know if this metaphor lands for people, but if you're going out hunting turkeys or something, and your gun's not loaded to go shoot turkeys, like good luck, right? Like the financing is basically like you loading up, right? I don't know why I thought of turkey hunting. I haven't ever been turkey hunting, but anyway, getting close to Thanksgiving here when I'm recording this.
That's right.
But the point is, like, financing is like, it's your fuel in the car, it's your loaded gun, whatever metaphor you want to use. If you don't have the fuel in the car, you can't confidently go out and buy the property. And so for me, I find this is such an important topic, and filling up the fuel in your tank with a lot of options, or filling up your toolbox with a lot of options, then it opens up the entire real estate business. There literally whatever you want to get to. And I'm a small, mighty investor. So for me, like, you just need 10, like you just need 15, you need 20, and you could be done. You could have financial freedom instead of being limited to those one or two. So I don't know. Do you have any other thoughts on just that big picture of having a toolbox and having scaling? Any other advice for investors when they're trying to work on that?
I'll give you a bonus tip, and I've done this, is buy a house with a close personal family friend or maybe a nephew or a niece, right? They don't need credit, they don't need income, but they need to live in the property for 12 months. So if you can find a buying partner, you can do 5% down at owner-occupied rates. Let them live in the house for 12 months. Let them house hack to get cheaper rent. And then after that 12 months, turn it into a long-term rental or a short-term rental. And that's 5% down. You can always buy a primary residence. So it's not your primary residence, it's somebody else's primary residence. But I've done this multiple times where we have an investor who has a lot of extra income and cash, but they just need a buying partner, right? So I love the college student. You can't have bad credit, but you can have no credit and have this work out. So lots of different options. And it's just networking and talking to people. I'm like, I never even thought of that.
We did talk about house hacking a lot, which is one of my favorites, but we were talking about more about scaling. But yeah, if you start opening up the conventional world of owner-occupied house hacking loans, like, man, now you've got a whole nother set of options. So I hope the tone today is optimism, and there's a lot of possibilities out there. Yes, interest rates have gone up. There's some challenges there of figuring out, like, how to make a property cash flow. Maybe I need to put more money down. Maybe I run out of cash faster. But the point here is there's a lot of options. And Bryan, I want to give you a chance to let people know how they can connect with you. I know having a consultation with you is something you do a ton of. So I'm going to put links to everything you say in the YouTube description and the podcast description, but let people know like the best way to reach out to you.
Yeah, jumping on my calendar, Chad, is a fantastic way to get on my attention. I've got the calendar invite. You can do a 15, 30, or a 60-minute consult. So if you've got kind of a project that's already underway, you're looking at a house, we probably don't need to go 60 minutes. We probably can do 15 or 30 minutes. But if you're kind of new to the investing arena, or you're wanting to kind of spitball some different things, schedule an hour appointment. If we end early, that's fantastic. But that's the easiest way for me to be able to kind of make sure I'm giving you some dedicated time, is just let's jump on that calendar and work together and see what you're trying to accomplish.
I think that's such valuable time. So if you're an investor and you want to just figure out the financing, remember the finding deals and then finding the money, like those are your two biggest limitations. And so having a conversation with Bryan is a great way to do it. And I've known Bryan, we didn't really tell this story too much at the beginning, but back 15, 16 years now, Bryan, when I was at the Charlotte RIA meetings, and we were both just hanging out there, and we started talking about loans and growing your business. So you're somebody who I know a lot of people have done loans with over the years, and I've trusted. So I hope people will reach out to you, connect with you, let you help them. And I want to hear the stories. Like I would love to hear some of these creative deals that all of you done when you're able to do your DSCR loan, when you're able to do your next conventional loan, your house hack. Let me know about it. I would love to hear that success story and connect with Bryan. Bryan, thank you for your time. Thanks for helping me unpack the toolbox today, and look forward to talking again soon.
It's been great, Chad. Thank you, sir.
Real quick, if you do decide to talk to Bryan about investor mortgages, my recommendation is to talk to him well before you actually make an offer on a property. If you do that, he can talk to you about closing costs and help you with all the details, which will be really helpful when you're actually running the numbers. So just a quick tip, I've had a mortgage professional on my team my entire career as a real estate investor, and it's a very handy thing to do well before you start making offers on properties. Best of luck. Hey, one more thing. In this video, we talked a lot about the mortgages you need to grow your rental portfolio. But what we didn't talk about was how big do you actually need to get? Do you need to have hundreds of rental properties, or could you do it with a lot less? So in the next episode, I want to share with you how you can achieve financial freedom with just 5 rental properties. It doesn't have to be that complicated. So if you click above me here, there's a thumbnail to go to the next video, or you can find a link in the podcast or the YouTube description below. You can watch that video and I'll explain it in simple terms and draw it out, a plan for you to achieve financial freedom with fewer rental properties. See you in the next video.